So, Omoike, what are the key issues in repatriation of capital and profits?
Thank you, Lee. We had introduced this in the previous slides. So there are certain taxes that should be considered when disposing of investments in Africa. The primary one is the capital gains tax. Some countries just introduce this in their system, while some have always had it from the beginning of time. So the rates again vary from maybe between 5%, probably 10 to 15% or so, depending on countries. And this is applicable on any gain that is realized from disposal or the sale of assets or shares in an entity in Africa. Again, it could be a direct sale of share or indirect sale of shares. That meaning that probably not the sale of the entity in Africa itself, maybe the sale of the parent of the African entity. They are selling the shares of that entity. It could have a capital gain implication in Africa. And when you also are dealing with assets that are considered as land rich in Africa, it could also create tax implications for the investor who is disposing of his investment. There are certain special taxation rules in certain jurisdictions in the year where a business in Africa ceases or where there is a liquidation of such businesses. You find that the rules for determining the tax liability for that year is a little different from that of a going concern, a business that is still continuing. So we have that in some jurisdictions like Nigeria. Transfer tax is also, we find that applicable. I think I will allow Gilles to come in here at some point to discuss the transfer tax in the Francophone countries, but transfer tax is also applicable in certain countries where there is a sale of transfer, where there is a sale of shares or a disposal of business. And withholding tax also applies to a payment of, say, dividends to investors or a payment of interest out of Africa, or even payment of management fees or royalties or things of that nature. Withholding tax would apply. So at the time of taking out your profit or repatriating your profit out of Africa, the tax authorities would require that there is a disclosure of the payment of the relevant, the correct amount of taxes, but for the relevant and the different types of taxes like that we just listed here. So before we move on to the exchange control regimes, I would like Gilles to probably enlighten us more on the transfer taxes in the Francophone countries. Gilles?
Thank you, Omoike, and it's something that is probably relevant for everyone, but maybe especially for the private equity industry, because usually the way it works, private equity would buy shares of a company, operating in Africa, trying to grow that company, and depending on the strategy, trying to exit after 3, 4, 5, 6 years, depending once again on the strategy of that specific investor. And getting back to what I was saying at the very beginning of this webcast, and why it's so important to anticipate, in fact, because the exit could trigger significant taxes. And Omoike mentioned the capital gain tax, but basically the capital gain tax only applies when there is a gain. So the seller, purchase the shares for 100, and is going to sell these shares for 150. There is a gain of 50, and that gain will be subject, for example, to a capital gain tax in, let's say, Senegal at 35%. So it is 35% on the gain. But the transfer tax, in fact, which can apply and usually applies in addition to the capital gain tax, applies even when there is no gain. In fact, every time shares in Francophone Africa are being transferred from one shareholder to the other one, and even, if that's done like 20 times in the same day down the chain or whatever, U.S. tax reason, these could also trigger some significant transfer tax implication. The transfer tax can range from basically like 1% to, in some countries, 5 or 6%. So as you can imagine, that can significantly impact the return on investment. And the capital gain is to be paid by the seller, whereas the transfer tax is usually to be paid by the buyer. And if the planning has not been done upfront, the addition of capital gain tax and transfer tax can sometimes be viewed as a deal breaker.
Thank you, Gilles. Moving on to the exchange control regimes. Across Africa, we have, like I mentioned earlier, we have there are certain jurisdictions that have very strict exchange control regimes. The popular one, Angola and Nigeria, where the authorities will require compliance with tax authorities, making sure that the right amount of taxes have been paid, making sure that at the time of bringing in the capital into the country, it was registered, and then you had the necessary fees, whatever, were paid. And so that at the point of taking out your profit, you are required to present those documentation, and before you could be allowed to take out your profit. Other things would include sourcing of foreign exchange. So today, it's very difficult to get USD out of Angola and Nigeria, primarily because it's not available. And also coupled with that is the rate, uncertainty as to the official rate to get the USD. So in Nigeria, they have what they call the managed rate, managed flow, where the government has not completely allowed people to source for foreign exchange from the market they feel is best for them, but they regulate it in some sectors, and they allow some other sectors to freely source for USD. So it's not helping investors get out profits from Nigeria. In Angola, it's even much more difficult, because again, it is not even available. Sourcing USD is not available, and investors have been looking for alternatives as to how to get out their profit from that jurisdiction. So this is subject to further discussion. Then we have economies that are kind of liberal. Liberia, for example, they don't have exchange control rules. Kenya as well. What we find in these countries is a requirement for you to probably report to the central bank when you are dealing in amounts that are maybe from $10,000 upward. So all you need to do is to disclose and say, we are trying to take a specific amount of money out of the country, and this is usually done by the local bankers on behalf of these companies. So it's kind of relaxed and easy. I think in South Africa, what they have done recently is to relax the foreign exchange control regime, such that probably the requirement is for you to before you come into South Africa, you register with the relevant regulatory body to say this investment in South Africa is owned by a non-resident company, so that at the time you want to take out your profits, they're already aware that, okay, this is going to come up because at the point of coming in, you had provided that information to them, ahead of time. So that is what we see in Africa in terms of the foreign exchange regime.
Well, I'll just take 1 minute just to mention that in addition to what Omoike was saying, South Africa is also implementing, in fact, has been implementing a few years ago what they call the headquarter company regime, which is basically a holding company regime, once again to attract money into South Africa as a gateway into Africa. And when a company, in fact, is registered in South Africa as a headquarter company, it is not subject to foreign exchange regulation. And then, obviously, we don't have time, to cover all the details. 54 countries, 54, different regulations. You also have countries like Algeria, for example, which have very strict foreign exchange regulation. All the payments, in fact, in Algeria have to be channeled through the central bank and need to be pre-approved, before any sort of money can leave the